Preparing for an investment analyst at SoftBank interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as an investment analyst at SoftBank? SoftBank appeals to me because it combines technology investing with a genuinely global perspective. I am interested in understanding businesses that could reshape industries, not simply screening mature companies on historical ratios. The analyst role would let me develop rigorous market, financial, and competitive analysis while learning how investment decisions are made across stages and geographies. I also appreciate that SoftBank's scale makes portfolio construction and risk management as important as identifying exceptional founders. While answering, connect your analytical skills to SoftBank's technology focus, explain your interest in transformative companies, and demonstrate awareness of its global platform, investment scale, and need for disciplined underwriting. Question 2. What do you know about SoftBank's investment strategy? SoftBank has historically pursued large-scale investments in technology businesses with the potential to become category leaders. Its approach spans growth equity, venture investing, and strategic technology exposure, often requiring long holding periods and substantial capital. That creates meaningful upside, but also sensitivity to valuation multiples, liquidity, macroeconomic conditions, and portfolio concentration. I would therefore view the strategy as high-conviction technology investing supported by rigorous diligence, active portfolio monitoring, and disciplined capital allocation. Make sure to cover SoftBank's technology orientation, growth and venture exposure, global reach, portfolio approach, capital intensity, and the importance of balancing ambitious upside with valuation and concentration risk. Question 3. How would you evaluate a technology company as an investment opportunity? I would begin with the market, its size, growth rate, structure, and realistic share opportunity. Then I would assess product differentiation, customer retention, pricing power, unit economics, management quality, and the capital required to reach scale. Financially, I would model revenue drivers, margins, cash burn, and multiple scenarios. Finally, I would compare valuation with public and private benchmarks and test whether plausible exit outcomes justify the risks, including competition and execution. In your answer, talk about market size, growth quality, competitive advantage, unit economics, management, capital needs, valuation, exit scenarios, and downside risks rather than relying on revenue growth alone. Question 4. Walk me through how you would build an investment thesis. I build a thesis by answering 3 questions. Why this market, why this company, and why now? I quantify the market opportunity, identify the company's durable advantage, and connect operating assumptions to revenue, margins, cash flow, and valuation. I then define catalysts, key risks, and downside cases. A strong thesis is falsifiable, so I specify the metrics or developments that would prove my assumptions wrong before recommending an investment. Be sure to mention the problem being solved, market opportunity, company edge, financial drivers, catalysts, risks, valuation, and explicit conditions that would invalidate the thesis. Question 5. How would you assess whether a startup's total addressable market is credible? I would prefer a bottom-up market estimate over simply quoting a large industry report. I would identify target customer segments, estimate the number of reachable customers, apply realistic adoption rates, and multiply by defensible annual revenue per customer. I would compare that result with top-down forecasts, then examine regulation, implementation friction, and competitive substitutes. The important distinction is between a theoretical market and the serviceable market this company can actually capture. Focus on bottom-up sizing, customer counts, realistic pricing, adoption constraints, market segmentation, competitive behavior, and reconciliation with top-down industry data. Question 6. Which operating metrics would you examine for a software or internet company? For a software company, I would examine annual recurring revenue growth, net revenue retention, gross margin, customer acquisition cost, payback period, and churn by cohort. For consumer internet businesses, engagement, conversion, frequency, average revenue per user, and contribution margin may matter more. I would also connect these metrics to cash burn and growth efficiency. A headline growth rate is incomplete without understanding retention quality and the cost of producing it. In your answer, distinguish metrics by business model and cover growth, retention, monetization, unit economics, engagement, cash efficiency, and cohort behavior. Question 7. Explain cohort analysis and why it matters in investment underwriting. Cohort analysis tracks customers who joined during the same period and follows their retention, usage, and revenue over time. It reveals whether growth comes from genuinely improving customer economics or merely from adding more users. For example, stable retention with rising monetization supports a stronger forecast than fast bookings growth accompanied by rapid churn. I would use cohorts to test customer lifetime value, payback assumptions, and whether management's aggregate metrics conceal deterioration. Make sure to cover customer grouping by acquisition period, retention and monetization trends, seasonality, payback, improving or deteriorating cohorts, and implications for forecasting sustainable growth. Question 8. How would you value a high-growth company with negative EBITDA? Negative EBITDA does not make valuation impossible, it changes the relevant evidence. I would use revenue or gross profit multiples from comparable companies, but adjust for growth, retention, margins, and market position. I would also build a DCF or operating model to understand the path to profitability and cash requirements. Scenario analysis is essential because terminal multiples and growth assumptions can dominate value. I would explicitly test dilution and runway if additional capital is needed. Discuss revenue multiples, discounted cash flow limitations, unit economics, path to profitability, comparable companies, scenario analysis, cash runway, and sensitivity to growth and multiple compression. Question 9. When would you use a DCF versus comparable company analysis? I would favor a DCF when the company has reasonably predictable cash flows and I can defend long-term operating assumptions. Comparable company analysis is more useful when the business is early stage, cash flow is negative, or market-based valuation is the primary reference point. In practice, I would use both where possible. Comparables provide an external reality check, while the DCF tests whether the implied value is supported by fundamental cash generation. Be sure to explain forecast maturity, cash flow visibility, peer availability, market conditions, terminal value risk, and using both methods as cross-checks rather than mechanically choosing one. Question 10. How would you calculate and interpret a revenue multiple? A revenue multiple is calculated by dividing enterprise value by a consistent revenue measure, such as forward 12-month revenue. I would ensure the numerator and denominator align and distinguish recurring, transactional, and low-quality revenue. Interpretation requires context. Faster growth, stronger retention, higher gross margins, and better cash conversion can justify a premium. I would compare the company with relevant peers, then test whether the multiple remains reasonable under slower growth or market compression. Cover enterprise value versus revenue, period consistency, growth and margin adjustments, recurring versus transactional revenue, cohort quality, and why a multiple is a comparison tool rather than a standalone valuation. Question 11. What makes a technology company's competitive advantage durable? A durable advantage prevents competitors from copying the product or taking customers economically. I would look for network effects, switching costs, proprietary data, distribution advantages, brand strength, scale economies, or genuinely differentiated technology. More importantly, I would seek evidence, improving retention, stable pricing, lower acquisition costs, and successful expansion can demonstrate durability. A temporary lead is not a moat. The advantage should strengthen as the company gains customers, data, or ecosystem relevance. Focus on network effects, switching costs, data advantages, brand, scale economies, distribution, ecosystem control, intellectual property, and evidence that advantages improve with growth. Question 12. How would you assess management quality during due diligence? I would assess whether management understands its market, communicates clearly, and consistently converts strategy into execution. I would compare historical forecasts with actual results, examine hiring and retention, and ask how leaders handled setbacks or missed targets. Transparency matters as much as charisma. I want management to distinguish facts from aspirations. I would also evaluate governance, incentives, capital allocation discipline, and whether founders can scale decision-making as the organization becomes more complex. Mention strategic clarity, execution history, hiring, capital allocation, transparency, intellectual honesty, governance, response to setbacks, and alignment with investors and stakeholders. Question 13. What is the difference between enterprise value and equity value? Equity value represents the value attributable to common shareholders. Enterprise value reflects the value of the operating business available to all capital providers, so it generally equals equity value plus debt and preferred interests, minus cash, with adjustments for minority interests when relevant. I use enterprise value with metrics such as revenue or EBITDA because those metrics are generated before financing decisions. Equity value is more appropriate when analyzing shareholder proceeds or per share value. In your answer, define both values, explain debt, cash, preferred securities, minority interests, and why enterprise value is commonly used with operating metrics. Question 14. How would rising interest rates affect a growth technology portfolio? Rising rates usually pressure growth technology valuations through higher discount rates and lower public market multiples. They can also increase funding costs, reduce investor risk appetite, and make long-duration cash flows less valuable today. Operationally, customers may delay spending, while capital-dependent companies face shorter runways. I would separate quality from duration. Strong retention, improving margins, and sufficient liquidity can protect a company better than growth unsupported by cash generation. Cover discount rates, present values, public market multiples, funding costs, runway, customer demand, exit markets, and differences between high-quality businesses and capital-dependent companies. Question 15. What would you include in a downside case for a SoftBank investment? My downside case would combine operational and valuation stress rather than changing only one assumption. I might model slower customer adoption, lower retention, margin pressure, delayed profitability, additional fundraising, and a materially lower exit multiple. I would also consider regulatory intervention, stronger competition, foreign exchange effects, and a longer holding period. The objective is to estimate capital impairment and identify whether the company has enough liquidity and strategic flexibility to survive adverse conditions. Discuss slower growth, margin pressure, delayed profitability, funding needs, dilution, multiple contraction, competitive threats, regulatory issues, liquidity, and exit timing. Question 16. How would you analyze a company's cash burn and runway? I would start with operating cash flow and distinguish gross burn from net burn after revenue and other inflows. Runway is typically available cash divided by monthly net burn, but I would adjust for working capital volatility, committed capital, debt obligations, and minimum liquidity needs. Then I would stress test burn under slower growth or continued investment. A company may appear well-funded on a headline basis but still require financing before reaching sustainable economics. Be sure to cover operating cash burn, gross versus net burn, cash balance, committed funding, working capital, monthly runway, financing needs, and sensitivity to growth investments. Question 17. What is dilution, and how would you model it in an investment case? Dilution occurs when new shares are issued, reducing an existing investor's percentage ownership. I would model the current capitalization table, option pool, preferred terms, and each future financing round. For example, investing $50 million at a $150 million pre-money valuation creates a $200 million post-money valuation, giving the new investor 25% before later dilution. I would carry ownership changes through exit proceeds, because company value growth does not automatically equal investor return growth. Explain new share issuance, ownership percentages, option pools, preferred securities, future financing, pre-money and post-money valuation, and impact on investor returns. Question 18. How would you evaluate a company operating in a highly regulated industry? I would map every regulation that affects licensing, customer acquisition, data use, pricing, capital requirements, and operations. Then I would assess management's compliance infrastructure, relationships with regulators, historical enforcement, and the probability and timing of policy changes. Regulation can be a moat when it raises barriers to entry, but it can also impair the model if approvals are uncertain or costs escalate. I would reflect those outcomes in scenarios, valuation, and required return. Focus on licensing, legal requirements, policy changes, compliance costs, regulatory relationships, market access, enforcement risk, and whether regulation creates barriers or threatens the business model. Question 19. Tell me about a time you used data to make an investment recommendation. In a university investment project, I analyzed a subscription company's declining growth. I segmented customers by acquisition quarter and found that newer cohorts had materially weaker retention, despite strong aggregate revenue. I investigated pricing and onboarding data, then recommended reducing paid acquisition until onboarding improved. The team incorporated that conclusion into its valuation and presentation. The experience taught me to challenge headline metrics, validate data quality, and translate analysis into a clear investment implication. Use a structured story covering the initial question, data sources, analysis, key insight, recommendation, uncertainty, and measurable result or learning. Question 20. How would you prioritize work when analyzing several potential investments at once? I would first clarify each opportunity's decision deadline and identify analyses that could change the investment conclusion. I would prioritize major risks, valuation drivers, and information gaps before polishing lower impact details. I would use a consistent model and diligence checklist, maintain a clear task tracker, and communicate early if timelines conflict. That approach protects quality while remaining practical. Senior investors need the most decision-relevant insight, not simply the largest volume of analysis. Mention investment relevance, deadlines, materiality, information gaps, decision dependencies, communication, repeatable templates, and escalating issues that could change the recommendation. Question 21. What questions would you ask a founder during an investment meeting? I would ask what urgent customer problem the product solves, why customers choose it, and what causes them to leave. I would probe retention by cohort, pricing power, contribution margins, acquisition channels, and the company's strongest competitive threat. I would also ask how new capital will be allocated, which milestones matter most, and what assumption management considers least certain. Strong questions should reveal both business quality and the team's self-awareness. Cover customer pain, product differentiation, retention, economics, competition, hiring, capital use, strategic priorities, risks, and the assumptions management is least certain about. Question 22. How would you evaluate a potential acquisition exit for a portfolio company? I would compare the buyer's offer with standalone value and alternative exit paths, including an IPO or another financial sponsor. I would assess strategic synergies, the buyer's ability to fund the transaction, comparable deal multiples, antitrust concerns, execution certainty, and timing. A higher headline price is not always better if closing risk is substantial or consideration is volatile. I would translate each scenario into expected investor proceeds and risk-adjusted returns. Discuss strategic rationale, buyer universe, synergies, standalone value, comparable transactions, antitrust, timing, certainty of closing, transaction costs, and proceeds under different offers. Question 23. What investment risks are especially important for SoftBank's global portfolio? A global technology portfolio faces risks beyond company-level execution. I would monitor currency movements, geopolitics, sanctions, local regulation, data sovereignty, capital controls, and differences in accounting or governance standards. Portfolio concentration can amplify correlated exposure to rates, technology cycles, or particular geographies. Liquidity and valuation risk also matter because private holdings may be difficult to exit. I would combine company-level diligence with portfolio-level stress testing to understand aggregate downside. Be sure to mention geographic concentration, currency, geopolitics, regulation, technology disruption, valuation, liquidity, cross-portfolio exposure, and differences in local market dynamics. Question 24. What is your approach to reviewing a financial model prepared by someone else? I review a model in layers. First, I understand its purpose and trace historical results to reliable source data. Next, I inspect formulas, sign conventions, debt and cash schedules, circularity, and balance checks. I then challenge key assumptions against operating evidence and compare outputs with management metrics and external benchmarks. Finally, I run sensitivities and extreme case tests. I want to know not only whether the model works mechanically, but whether its conclusions are economically credible. Explain checking structure, historical integrity, formulas, assumptions, circularity, sources, balance checks, sensitivities, reasonableness, and reconciliation to management's reported metrics. Question 25. What qualities would make you effective as a SoftBank investment analyst? I would bring analytical rigor, curiosity, and a strong sense of ownership. I enjoy breaking complex businesses into measurable drivers, testing assumptions, and communicating conclusions clearly to decision makers. I am also comfortable acknowledging uncertainty and changing my view when evidence changes. In a global investment environment, collaboration and cultural awareness matter alongside technical skills. My goal would be to produce accurate, decision-relevant work quickly while constructively challenging assumptions and learning continuously. Highlight intellectual curiosity, numerical rigor, clear communication, humility, speed, attention to detail, ownership, teamwork across cultures, and willingness to challenge assumptions constructively. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.